Welcome to IFA Brazil ABDF's webinar on the OECD Blueprint on Pillars 1 and 2. According to the OECD, due to digitalization, globalization, and new business models, many multinational enterprises are able to make large profits in countries without booking and taxing these profits in these countries. They attribute this to the fact that these companies may operate business without establishing any physical presence. They also attribute it to the fact that rules to allocate profits are no longer proper for a globalized, highly digitalized economy, where value is concentrated on intangibles. The current international tax rules would need, therefore, to be updated with a new nexus concept and new profit allocation rules. The OECD has been affirming that there is now widespread agreement that the current rules must be adapted, ensuring that all business, and not just those in the digital sector, should pay their fair share of taxes where they have activities and where they earn their profits. In the absence of a multilateral solution, countries have started adopting unilateral measures which may, according to the OECD, further jeopardize the integrity of the international tax system. But is it really true? There is really now widespread agreement, and are we even close to a consensus? Taking this into consideration, we invited today to be here two very, very, very special guests. The guest I'm going to introduce now is the person to blame for my passion for international taxation. I had the absolutely joy of being his student in Leiden about 20 years ago. Professor Kees van Raad is chairman of the International Tax Center of Leiden, of counsel to Loyens and Loeff, and past professor of international tax law at the University of Leiden. He's also chair of the International Fiscal Association's jury for the annual Mitchell Carroll Prize, a past member of its permanent scientific committee, and an honorary member of IFA. Professor Van Raad is, without any doubt, one of the most important scholars in international taxation we currently have in the globe. I will now ask my dear friend Edgar to introduce another dear friend, Sérgio André Rocha, who we had the honor to hear last week talking about exactly the same subject in ABDF's international conference. Today, it will be a great opportunity to hear his thoughts again and without the same time limit constraints. So now, Edgar.
Hello, Anna. Good morning, everyone. Before introducing Professor Sérgio André, I would like to say thank you to everyone watching us live, and also for everyone that will watch us later on the ABDF channel on YouTube. In addition, I also would like to say thank you to Anna for the invitation to join the seminar and for the entire organization. It's always a pleasure to be on an ABDF event, and it is even greater pleasure when I'm together with Professors Kees van Raad, Sérgio André, and also Ana Carolina Monguilo. I'm not quite sure if you all remember, but we were also together around 7 years ago, live in Rio de Janeiro at ABDF premise, discussing back then important, recent, and relevant developments of international taxation. The topics were the OECD proposals regarding beneficial ownership and permanent establishment, as well as Brazilian CFC rules. A couple of years later, we were also together during the first edition of the ITC summer course in Brazil, which in that year also took place in Rio, as well in São Paulo, and in Rio was at the ABDF premises. Having said that, and before asking Professor Van Raad to tell us his considerations concerning the OECD blueprints on pillars 1 and 2, which Anna already made a the introduction about the topic, so I'm not going to repeat it. I would like to remind you all the next Monday, we will start the first edition of the International Tax Center online executive program in international tax law for Brazil, Portugal, and Angola. The course will be taught mostly in Portuguese and partially in English by teachers of ITC Leiden, including Professor Kees van Haan, and ITC alumni from Portugal and Brazil, such as Anna and I. Pillars 1 and 2 will be together with the UN initiative for a new tax treaty provision regarding Article 12b, will be a topic of the advanced course, which Professor Sergio André will also give us the pleasure to teach during this advanced subject course. Knowing that this is a broad topic, I will stop talking and will introduce Professor Sergio André Rocha. Sergio is a professor doctor at the Rio de Janeiro State University. He's academic coordinator at the Center for Applied Studies in Law, SEAD, invited professor for the LLM in International Tax Law at the University of Amsterdam, professor and instructor for several specialized courses in tax law, postdoctorate livre docente in tax law from the University of São Paulo, PhD in Law and Economics from the University Gama Filho, Masters in Law and Economics from the University Gama Filho, and postgraduate studies in private law from Universidade Federal Fluminense, UF. So, having said that, I kindly invite Kees to give us his thoughts concerning pillars 1 and 2. Please, Kees.
Well, thank you so much. Great. Well, many thanks, Anna. Many thanks, Edgar. Many thanks, Sergio, for joining me later. It's an enormous pleasure to, and it's also an opportunity. One of the few good things about COVID is that we have much more easily organized these international conferences, and I'm very pleased and happy and grateful for you for inviting me to give this introduction on the 2 pillars of the OECD blueprints. As we all know, the OECD worked for many years on the BEPS project, and well, after the conclusion of that a few years ago, it was realized there was a bit more work to be done, particularly in the area of taxation of businesses operating in the digital economy. And well, and then based on the US tax reform, it was also decided to see whether a global approach to minimum level taxation could be developed within the OECD. So let's first address pillar 1. So let's go to the next slide. It's interesting, Anna mentioned when she was informing you of my credentials that I'm a member of the jury of the Mitchell B. Carroll Prize. Well, Mitchell B. Carroll was the first president of IFA, and he was active in the 1920s and 1930s. And what we look here at is a report that was actually prepared by him, a report of 1932, so almost 100 years ago. And it's interesting that the problem we are discussing today is also a problem that was already perceived and addressed in those years. So let's see what it says. It says one of the most difficult problems involved in the prevention of double taxation is the allocation and apportionment of income of enterprises between various countries. So 88 years ago, this was already stated that this was an area where solutions were not that easy. Okay, let's move to the next slide. And here we see that typically countries will in the application of the ordinary taxation rules apply 2 basic rules, and the basic rules refer to the nexus, the connection between a taxpayer and his income and a particular country. So the residence country of the taxpayer is typically entitled to tax the taxpayer's worldwide income. And in addition, if that taxpayer derives income from other country, that other country where the source of the income is, may also tax that. So these are the typically 2 leading rules for exercising tax jurisdiction we have been applying so far. Again, the residence country, no restrictions. Source country is restricted to the income that is produced by the activities going on in that country. Where business concerned, typically an activity may take the form of a permanent establishment, and the income attributable to the permanent establishment is going to be determined on the basis of the arm's length principle. And this was spelled out in great detail in a 2010 report on the income attribution to permanent establishment. So this is an area where a lot of work was done by the OECD until some 10 years ago. Let's move to the next slide. It's interesting that in the United States, also a century ago, when the individual states started taxing income, they took an approach that is very different from the approach taken later internationally. So they did not apply the residence principle, they did not apply the source principle, they did something entirely different. It's something called unitary taxation or formula apportionment. Many US companies operating in the United States obviously operate in more than one single state. And the issue arising then is the same as the issue that arises internationally. How do you divide income that the US company earns by carrying on business in more than one state? How do you allocate separate parts of the profits to each individual state? And again, they took an approach a long time ago, very simple approach, very different from the approach that was later developed within the framework of tax treaties and so on. Well, this formula apportionment is an approach where the income would be attributed to countries on the basis of three factors. And those factors are capital, that's the amount of capital invested, payroll, that refers to the wages paid, and sales, simply what is a particular company selling in the different states. And on the basis of these three factors, and each of these three factors would carry the same weight, income will be attributed. Interestingly, this system is still being applied by US states, although the three-factor formula has developed a bit. What we see right now is that in many of the states, more weight is given to the sales factor than to the other factors. So very few states apply the system with equal weight being given to each of the three factors. So each state makes its own choice, and many states make a choice for giving more weight to sales. Why am I mentioning this? Well, let's move to the next slide. What we see in this bit complicated picture is we see actually three groups of states. We see on the left-hand side the resident state of, let's say, a multinational enterprise where the main office is situated, and that multinational enterprise does business probably in state R, but particularly in state S, the middle group, where it carries on business through a permanent establishment and also through a subsidiary. Well, subsidiary technically is not a company that's going to be taxed on the basis of its source. No, it's a resident by itself. But viewed from the perspective of the multinational enterprise, one could say the multinational enterprise is a single residence in the country where the parent company is located and is doing business in other countries through either a PE or through a subsidiary. Well, in this particular picture, you see that the permanent establishment is selling in its own state S, but also selling in other countries on the right-hand side. And the same is true for the subsidiary. So the countries on the right-hand side are the countries where the sales, well, actually where the consumers live, to whom the sales are being made. Well, the traditional tax rules only look actually at the left part of the picture. They look at the countries where the true business activities take place, where the company is present through its head office, through sales offices, through manufacturing facilities, and what have you. Physical presence carrying on business physically in those countries is the basis for taxing those countries, either on the basis of the residence principle or on the basis of the source principle. What we never paid in ordinary income taxation internationally any attention to is that all those activities only can lead to profit making if there are people that are going to buy those products, going to buy the physical products, going to buy the services. And interesting, and that's the reason why we, in the earlier slide, look at the US state tax system. In that system, they already paid attention for many decades to where the sales are affected, where the consumers are. And that's exactly the point that's being addressed by the blueprints, the pillar 1 and the pillar 2 approach. We look at also now that income cannot be earned if you don't have a customer base in countries. So the challenge now is, and that's what the blueprints are about, particularly blueprint on pillar 1, is that so far we looked only at the left side countries, state R, state S, and now we're gonna also look to the right hand side countries that in this perspective should also be entitled to a part of the overall pie that's going to be distributed among the countries. And that's at the same time a challenge, because so far only the left countries would tax the overall amount of the profit. And now under the proposals of pillar 1, that revenue taxing right is going to be shared with countries on the right hand side. Well, let's move to the next slide. So this all started with BEPS, and as you may know, BEPS 15 actions. Action 1 dealt with the digital economy, and BEPS Action 1 report, although it was the thickest report, it was at the same time the only report that wasn't really finished. The challenge is the people working together on the subject of BEPS Action 1 was so large that they simply were not able, within the limited time available, to come up with a solution. And that's the reason why this was taken up by the OECD for further studies within the framework of Pillar 1. And about a month and a half ago, on 12th October, the OECD published blueprint reports on Pillar 1 and additional Pillar 2. And the point of the Pillar 1 report is to create an additional taxing right for these marketing jurisdictions where, again, no business activity is taking place, there are no offices, there are no sales activities, there are no manufacturing activities taking on. No. These are the countries where the consumers are based and where value is being created for the company through this customer base. Well, the challenge is obvious. If you carry on your business in different countries through activities that take place physically in those countries, there is a basis to which you can attribute income. You can deem that the activity taking place there is an activity by a company as if it were an independent company. And the arm's length principle guides us in determining how much income is going to be attributable to that. Well, where the marketing jurisdictions enter the discussions, there is not such a basis for income attribution. There is no independent business activity taking place. There's only consumers there. So the decision as to how much income is going to be subject to taxation by those marketing jurisdictions is not a technical discussion. No, that's a political discussion. So politically, it has to be decided how much of the overall profit, what sort of percentage should be left to those countries to be taxed by them. Well, let's move to the next slide. Well, in order to do that, what we start out with is determining the profit that's going to be made not on a company by company basis, but on a group basis. So on the left-hand side, you see within this dotted red line, you see the parent company. In the left-hand state, you see the permanent establishment in one of the right-hand states and the subsidiary, and they are all put together, and they together will be responsible for the overall profit, the global profit that is going to be made by the MNE. Let's move to the next slide. And the next step we're going to do then in the framework of our procedure to determine how much income may be taxed by the marketing jurisdictions is determine what part of the overall global profit can be considered to be the deemed routine profit. So it's assumed that on the average, a company will make an ordinary profit at an ordinary profit ratio. And that ratio, that's going to be a fixed percentage, that's going to be applied to the overall profits, and that will produce what we see here at the bottom, this yellow-green part, the deemed routine profit. And if you deduct that from the overall profit of the MNE, you have in the top a deemed residual profit. And that's the profit from which the marketing jurisdictions are going to get a share. Let's move to the next slide. So the political choice to be made is, if we have this amount of residual profit, what part of that residual profit is going to be available for the marketing jurisdictions to be taxed? And we refer to that amount as the amount A. This amount A, again, is an amount that's going to be determined on the basis of a political agreement among the countries involved, what they feel is a fair percentage to be left over to the marketing jurisdictions to be taxed by them. It's going to be a fraction of the overall amount. Next, of course, this amount A going to be distributed among all the different marketing jurisdictions. So that's going to be another division that's going to be made on the basis of a formula. And all this stuff still needs to be agreed upon politically. So if we look now at the Pillar 1 blueprint, a FET report of well over 100 pages, these are the things you won't find an answer yet in those reports, because these are questions that's going to be answered politically. There is no technical answer for them. Let's move to the next slide. Well, the early discussion that was going on is whether this approach, where an amount A, part of that is going to be available to the marketing jurisdictions, whether that exercise will be done only for companies that typically work in digital business. Companies like Facebook, Google, Microsoft, Amazon, and so on. Or do we say, well, digital economy goes beyond those sort of companies, and we should also probably have companies subject to this system when they, in a different way, are involved in the digital economy. And that was a very difficult choice to be made, and in the current report, a choice is made that, in addition to what we see here on this slide, companies that are engaged in rendering automated digital services, also other companies may be subject to this approach. Well, let's first look at this automated digital service company segment. We are addressing here companies that produce services, as it's stated here, that require no or only minimal human intervention. And those services are typically provided over the internet or within an electronic network. The types of businesses that are covered by this regime is reflected through three things. In the first place, they've made a list of all types of companies that should be typically covered by it. And secondly, a list was prepared that provides which branches of industry are outside that list. For example, banks will be outside of that list. International shipping and airline industry will be outside that list. And then there's a general definition. So in practice, a company will first check, am I covered by the positive list? Am I included by the negative list? And if you still don't have an answer, you're going to look at in the general definition. Of course, many businesses will be engaged in types of activities, only part of which will be covered by ADS and another part not. So there are also the rules prepared that will take care of how to make the division. Let's move to the next slide. Well, the second category of businesses is called consumer-facing businesses. And those are businesses where typically goods and services are being provided to consumers. Consumers that are buying things for their own personal consumption and not for business purposes. And that's the idea of consumer facing. Well, we are not only referring to retailers. No. We're also referring to manufacturers of products and services that eventually will be sold to mostly to consumers and not for business to business use. Very complex. Big fights have been fought in the background whether a particular type of business would or would not be covered by this consumer facing business. A lot of debate is still going on, but this is a second category in addition to the automated digital services, which is going to be covered by this pillar one approach. And again, an approach where part of the overall profits is going to be made available to marketing jurisdictions where no business activities take place, marketing jurisdictions that may tax that a fraction of that amount A profit. Let's move to the next slide. Well, in view of the limited time, let's skip this one and let's go to the next one. Well, it's going to be clear that if we're going to indeed put these rules on the pillar one into effect, that we have to change tax treaties in important respects. Article 7 that now deals with which countries may tax business profits, the residence country and the source country, has to be changed because of the marketing jurisdiction approach. Those countries may tax without an ordinary permanent establishment being present in such a country. And also the double taxation relief rules have to be adjusted when part of the group's profit is going to be taxable in the marketing jurisdictions countries. That's going to be double tax. And which of the group companies is going to give relief for that? Also, detailed rules are being prepared for that. Let's move to the next slide. Well, this slide addresses something which is a little different. It turns out that in practice, marketing and distribution activities often give rise to difficult transfer pricing discussions between the countries involved. So along with rules on determination of amount A, also an amount B has been singled out, and that amount B reflects the income that's being earned with the marketing and distribution activities, and it's being proposed to compute the profit that is made through these activities in a standard way that gives less rise to cross-border discussions. So amount A and amount B are the two key features of this particular pillar one proposal. Let's move to the next slide. And I think we move on to the next one because time is limited. All these things we've discussed so far will give rise to questions and issues, and it will be quite predictable that countries involved may disagree on particular initial outcomes. As a result of that, it may happen that the taxpaying group will be subject to double tax. So a whole set of rules have been developed to create tax certainty. And we won't go into any detail, but these tax certainty rules will provide for the possibility for early determination of the liabilities in the different countries, and in this way try to prevent issues from arising. And when issues do arise, other rules will be applied that will take care of the resolution of the of the disputes. Excuse me. And that in that respect, also arbitration, effectively mandatory binding arbitration, is being considered. Let's go to the next slide. Timeline. We have about 2 more weeks, as you see here, 14 December. Firms, companies, individuals, academics are being invited to submit to the OECD their answers to a number of technical questions the OECD has made available to the public at large to assist the OECD in solving many of these issues. And it's hoped for by the OECD that in the middle of next year, many of the political issues will be solved through an extended discussion among the parties involved. In the end, there will be another multilateral treaty that will assist in the correct implementation of the various rules that are being discussed now in the tax treaties among the countries involved. Next one, please. Well, the Pillar 2 proposals are of an entirely different nature. I'll be quite brief in this respect. Pillar 2 basically is a proposal quite conceptually entirely unrelated to Pillar 1. Pillar 2 focuses on the desirability that companies, if they manage, despite all the actions that were developed by the OECD within the framework of BEPS, if companies manage still to pay a tax rate that is what is considered to be below standard from a global perspective, to provide rules that will lead to an add-on on the overall tax bill in such a way that multinational enterprises more or less will be paying the same effective tax rate on their global profits. In order to avoid situations like we learned from the EU proceedings against Apple in recent years, that Apple managed to keep a very large chunk of its global profits basically tax-free by engaging in a completely legitimate but quite sophisticated structure involving Ireland and the way the treaties between the United States, Ireland, and other countries operate. So the Pillar 2 proposals is basically a proposal to eliminate possibilities that companies, through completely, again, legitimate but very clever organizing their tax affairs around the world, are able to accomplish effective tax rates that are considered to be too low. Well, I've listed here a few key points to be discussed. The taxpayers that are targeted here are basically the same taxpayers as we saw for Pillar 1. Those are the MNEs with a gross revenue of what we see here, 750 million annually at a global level. Let's move to the next slide. The proposal actually applies 4 different rules, all of which, I won't get into any detail on any rule, all of which together will produce the effect that companies will end up paying a fixed percentage. And also here, the percentage isn't being fixed yet. Discussions are on a percentage anywhere between 10% and 20%. That percentage should be affected through the application of these rules that jointly effectively work as a CFC regime, a controlled foreign company regime, where effectively all the income that's earned among these different group companies in their totality is going to be taxed at a preset level. Also here, the implementation of the rules will require pretty important updates and changes to tax treaties. And also this change will be affected through a multilateral instrument as is planned right now. Let's move to the next one. Quite a few political points are being still open to be discussed. That is a discussion that will take place in the next 6 months. There are political issues, also a few technical issues, and we all hope that it will work to have by the middle of next summer agreement reached on these various items. Let's move to the next slide. Let me then do a little bit of advertising. Today is Tuesday. Next Monday, ITC is going to start a 6-week program, 2 weeks in December, 2 weeks in January, 2 weeks in February, an executive program where we will have 2 weeks of tax treaties, 2 weeks of advanced subjects, and 2 weeks of transfer pricing. Let's move to the next slide. And these are the topics that are going to be covered in the tax treaty course. I will be teaching myself, particularly in this course. This is where my expertise is, not so much in transfer pricing, but more in the tax treaty area. So there will be a day, 3 hours of lectures on each of these topics, followed by days of workshops on these topics where people learn how things work in practice. And the next slide will show the advanced topics that we will be discussing. As you see here, is topic 7. There's going to be a separate day for pillar 1 and pillar 2. So if you want to know more than I was able to tell you in the 20 or so minutes I've been speaking on that topic, do go to this particular course. And then the last course, course C, deals with transfer pricing. Current things, but also look at 7 and 8, how transfer pricing in the digital economy may work and what the challenges are for transfer pricing in the years to come. And then we get to the final slide. And that is, if you want to register for this, one of these different courses or for all 3, do go to the website of ITC. And if you would register before the end of this week, this Friday, you will qualify for an additional discount of 10%. So far, so good. I'll be happy to answer questions after Sergio has done his presentation. Thank you.
Thank you so much, Kees. It's always fascinating to hear you, and I missed I missed your lectures very much. Thank you so much. And well, I just wanted to remind our public that I mentioned it in the chat, but you can check out Professor's Kees Van Rad slides in a link that we had in the YouTube channel, where you have the description for the video. You have a link there where you will have access to Professor's Kees slides. And if you want to make questions for us to take to Professor Kees and Professor Sergio André, you can just put your question in the chat, because after Sergio André Rocha gives his lecture to us, we will have a brief debate between them. So now, without any delays, I would give the mic to our dear friend, Professor Sergio André Rocha. Thank you so much, Sergio André.
Well, thank you, Ana Carolina. It's a great pleasure to be here this morning. As you said, Case is one of the greatest international tax scholars of all time. So it's a pleasure to be sharing this panel with him this morning. It's a great pleasure to be with you and Edgar, who I know so well and who have been doing such a great work here in Brazil and Rio, in São Paulo, in the case of Ana Carolina, to move forward to move the studies on international taxation forward. It's again, I can never not congratulate IBDF, so Brazil's IFA branch, for the outstanding work it has done during this challenging year. I'm always amazed by all the things ABDF has done throughout this year. It's fantastic. So as always, my congratulations to our president, Gustavo Brigagão. But I would be remiss if I didn't mention the very important role that Ana Carolina played this year. So I lost count of the many, off the chart events that Ana Carolina was behind. So, and this is another one. So Ana Carolina, my congratulations to you. I think you're a big part of the success that ABDF has had during this year. So congratulations to you, and I hope you have the energy to keep up with the good work during 2021. Having said that, I know that our time is short. As always, I'm gonna set my clock here, because you know that I like to stick to the clock, to the time. As Ana Carolina said, I'm gonna maybe repeat some of the things I've said last week during our Congress, but also maybe add some things and conclude. I guess that what you were missing last week was a conclusion. I was very, very happy to hear Kay say that, and quoting Mitchell B. Carroll, that the central question, the most relevant question in international taxation is how you share taxing revenues among countries, and how do you come up with a criteria that is fair in this process of sharing taxing revenues. And I guess since the dawn of international taxation, we haven't been able to do that. I said this last week, and I've been saying this for many years now, that the criteria we came up back in the early 20th century has never been a good one. So the so-called international tax regime, it has always favored more developed countries, and it has always been a terrible criteria for developing and emerging economies. And sometimes when I say that, it seems that I'm implying that there was some kind of plot by developed economies and developed countries, like let's do something that will be very bad for those developing economies. And I don't think that that's the case. We need to put ourselves back in time. So international taxation emerged during the second industrial revolution. So it was an economy that was pretty much fixed. And in developing criteria for allocating taxing rights in the 20s, the 1920s, the criteria that were established back then mostly favored residence countries. I've mentioned that one of the only developing countries participating and engaging in those discussions was Chile. And back in 1927, Chilean authorities already pointed out that, this is not good for us. So the idea of a permanent establishment, that's really bad for us. The idea that the consumer country can only tax if there is a fixed presence, It makes no sense to us. And so this is a point I've been making for many years now. The whole system, the whole international tax regime, it has been broken from scratch. So it doesn't work for a developing country. And we have been arguing these for many, many decades. Latin America in general has been a beacon of light in this discussion. And during my last presentation, I raised the issue of the paradox of the foundations of the international taxation studies in Brazil, because we owe the foundation of international taxation in the country to Professor Roberto Xavier, who's no longer with us, and we all dearly respect. But the matter of fact is that Professor Roberto has always had an OECD-centric kind of thinking. So he was never able to think as an academic from a developing country. So he was always a Portuguese scholar that was in the colony and, you know, bringing mirrors to the Indians. And so here in Brazil, we had very tough time to develop some kind of critical thinking in terms of international taxation, I guess, to some extent due to this influence of Alberto's thinking. Also because international taxation in Brazil is mostly studied and written by lawyers who more often than not are more concerned with their clients' interests than in thinking critically about international taxation, and they have a very tough time to think about the interests of the state and not the immediate interests of their clients. So I think that there's another bias that we have in the study of international taxation in Brazil. And so having this background, we reach you the discussions on BAPS 1 and Pillars 1 and 2. I think that first, again, in general, we are importing a problem that's not ours. It already happened with BAPS. So the whole BAPS project was a consequence of the huge fiscal crisis due to the financial crisis of 2008, 2009. And it wasn't really our concern. And then all of a sudden, it was all about BAPS. If we look closely now with the historical perspective, what were the huge changes we had in Brazil because of BAPS? I don't see many. And even so, the time we dedicated to this and the time it consumed was huge. And actually, we were trying to deal with a problem that was mostly a problem of developed countries. And I guess the same thing is happening with all this Pillar 1 and Pillar 2 thing. In our panel last week, I remember Grace Perez Navarro from the OECD just saying, yeah, we have to fix this because otherwise there will be economic sanctions. I think that this is a very fair point, and it points out that actually we have this kind of international, commercial, and political entanglement, and it has been decided that we have to move in this direction. Otherwise, there will be some kind of commercial wars among developed countries. But you know, in the end, what do we have to do with this? What we have to do with the fact that France, Germany, and the United States are having a tough time, you know, with all this commercial war surrounding the digital economy. When we look at the very enlightening presentation Case has delivered us, and we pay attention to the automated digital services, do we really need to go through all the complexities of Pillar 1 in order to find a way to tax automated digital services? And I think that what is more intriguing is, and here there's an important comment. I'm not talking specifically about Brazil. I'm trying to think about this from the perspective of developing countries in general, even if the concept of developing countries is very, very broad in nature, because you have countries with very, very different economic, political, social backgrounds in this same pool called developing countries or emerging economies. But if you think from a developing countries perspective, is Pillar 1 and fighting for Amount A better than just acknowledging the source country's right to tax services at source, digital, non-digital? I think, services in general. I've been arguing for quite some time now that the major problem is with Article 7 and the idea that business profits should be taxed at the country of residence. And the work the UN has been doing to dehydrate Article 7, with Article 12A, now with Article 12B, I think in terms of sharing taxing rights more fairly is way better than Pillar 1 and talking about Amount A, for instance. Because when we talk about scope, and again, Case explained to us pretty well that the idea is not to tax residual profits of every entity, operating in all sectors and of all sizes. So there is this idea of trying to limit the scope of application of these rules. And my point here is why? Why are we going to limit this? So as a source country, it doesn't matter to me if the overall profit of the multinational is higher than 750 million euros. I really don't care. The point is, the foreign entity is making money in my territory. Keith made an assertion. He said, no, there are no business activities at the source country. And when you say that there are no business activities, you assume that business activities are production activities, are related to the execution of the main activities of the enterprise. But in the end, consuming is as much of a business activity as producing. There are two sides of the coin. So the mere fact that the consumer is in my territory should allow me to tax a share of the income. And I guess that the simpler way to share the taxing rights over this income is just to assign some taxing rights to the source country and let the source country withhold its source. Some will say, oh yeah, but this is not a problem in Brazil. Indeed, this is not a problem in Brazil. The problem in Brazil is the opposite. We have a very high source taxation on services in general. But again, I'm not talking specifically about Brazil. I think that the main question is, why should a developing nation be all excited in engaging in discussions about Pillar 1? They should be all excited and engaged in discussions about how to make Articles 12A and 12B of the UN model universal. Discussions on how to dehydrate more Article 7, which is it's a residue of a different era. So my point here is, if we look at Brazil, one may say that, okay, we are participating, and here I want you to say something, because I'm always very critical about the OECD, but it's not about the OECD. My criticism is about our lack of criticism in importing OECD's recommendations. Of course, I can't say anything about the OECD. The OECD does its work. So if my criticism is not against the OECD, it's not that I'm saying that the OECD is trying to manipulate the international tax system to favor countries A, B, and C. That's not my point. My point is that we need to be more critical when importing and studying and considering OECD's recommendations. In the case of Brazil, I would say that the closer relationship we have established with them has been very good for us in general. If we look, the upgrade that Brazil's tax administration has had, that Brazilian authorities have had during this past decade, it's been tremendous. So it's you cannot argue that it's been entirely bad for us to be in a closer connection with the OECD. And you can even say that, okay, Sergio, you're saying that withholding at source is relevant, but we already do that. But my main question here is, so I have 2 points, and I'm coming to my conclusion. I have 2 points here. To developing countries in general, I don't think Pillar 1 is the great solution. I think we should be looking more into what's happening at the UN, and they should look more into what Brazil has been doing for the past decades. So that's one conclusion that I would like to reach. In relation to Brazil, we already do so much. Here, I think that we should review the assumption that we can keep everything that we have, and we can add whatever comes out of the OECD's discussions and whatever comes out of the Action 1 outcomes. So this idea that we will continue with this excessive burden on the importation of services in general, but we will add other things, that we will implement OECD's transfer pricing, but we will continue with the full inclusion CFC, and we will continue taxing at source at very high rates. I think that in relation to Brazil, either we will follow and to some extent adapt to what they're doing outside of Brazil, or we will stick to what we've been doing. I think that because it seems to me that to some extent we are kind of wanting to have the best of the both worlds. So we'll keep our eccentric, to some extent eccentric policies, but we will, add whatever comes out of these discussions. And finally, I just wanted to make one comment, because if we consider the whole discussions on digital economy, I think there are 2 different things. There is one thing that is the situation in which an entity or a company, multinational from one country, manages to explore the consumer market of the other country, and we are trying to find a way to give taxing rights to the source country. This is one thing, and this is a problem that we mostly do not have in Brazil, because we have the rules to tax this. Another thing is are the challenges that come, for instance, for the relevance of data in the digital economy. So the fact that Facebook uses data from Brazilian residents to provide better services to its customers outside of Brazil. In this case, we really have a different type of problem, because Facebook is not making money in Brazil. It's using data from Brazil, which is an input that the Brazilian resident is exchanging for being allowed to use some services like email and search engines and etc. And so it's an input that Facebook's uses to provide its services and earn revenues outside of Brazil. These are two different problems. And the ways to deal with these two different situations for me are different. Of course, we don't have rules to deal with the data issue, with the data economy. So that's something that's not conveyed in our rules. But we are totally equipped in Brazil to deal with the fact that you have digital companies making money here. It's sufficient to say that since 2014, we have had in our legislation rules on the taxation of automated digital services that the UN only discovered now in 2020. So these are my comments. I'd like to thank you all again for the attention, Anna and Edgar, for the invitation. And of course, I'll be here for us to talk a little bit more if you want to.
Thank you, Sergio. Thank you very much for your lecture. I do have a few questions for both of you. First of one was that the OECD expects to reach a consensus regarding Pillar 1 by mid-2021. This consensus should reduce tax complexity as well as provide tax certainty. On the other hand, I heard you both saying the words complexity, difficulty TP discussions, political questions, at least one or two times. So my question is, how realistic do you think it is that we will reach a consensus by mid-2021? And also, this consensus would give us less complexity or more complexity? If not reaching a consensus, are we close from starting a tax war between jurisdictions, applying domestic unilateral measures such as digital taxation? What do you think?
Well, it's a I wish I could look ahead 12 months. It's, to me, it's absolutely unclear whether OECD will be able to find any solution in the middle of next year. The challenge is that and then I particularly refer to Pillar 1. Pillar 1 creates an enormously complicated set of rules. And the rules are so complicated because if you keep them simple, we are engaged in what you can call rough justice. It will be in a very imprecise way, companies will be receiving additional tax burdens. But in order to make it more accurate, the complexity of the rules is breathtaking. If you see how many very smart, very well-trained international tax lawyers around the world have been spending hours and days and weeks trying to digest the details of the proposals. If it's so difficult for that sort of people, how are countries with very poorly equipped revenue departments, how are they going to deal with that? No way. I've heard also from the inside that the meetings of the group of countries working together, that the block of developing countries, they have pretty much remained silent because they have little clue what the whole thing is about. I mean, they simply don't understand. And the only hope for that, if anything goes through, that it will at least produce some additional revenue. They themselves will be quite incapable of implementing the rules that they are expected to work on if it's going to be approved. So that being said, in hindsight, one could wonder whether a more principled approach, where rather than adding something onto an existing system which already creates a lot of doubts and queries and so on, where a principled approach where you sort of step back and see, okay, we live in a different world. The rules we have been applying so far were prepared for a world that's not our world anymore. Let's step back and let's redesign the system. And instead of redesigning, we have simply added on to a system that was already very complicated, rules which are, almost impossible to apply. But that's sort of in hindsight. The parties, the OECD, were under enormous time pressure, and they simply did not have the time for this step back and sort of reflecting on what would have been the better approach. But I'm puzzled. Let me add one thing to this. There be some, and that's a particular point I would like to bring up to Sergio Andre. That is, I've heard that there are also rumors about a Pillar 3 approach, particularly for the developing countries. And I've been unable to fully understand, how in a Pillar 3 approach, developing countries would sort of benefit from further ideas how things could be done. I would be very much appreciative if I could learn from you, Sergio, about what you've heard about this Pillar 3 approach for particularly developing countries. And if I understand it correctly, they don't aim at countries like Brazil or China. No, they really aim at countries like African countries. So far, thanks.
There are two very good questions. I think that going back to Edgar's point, it's funny because to some extent it's like we are trying to deactivate the bomb that we planted. So we are creating a system that is very complex. Then we need to develop further the dispute resolution mechanisms because the system is becoming more and more complex and more prone to triggering international tax disputes. So it's like a circular thing. We create complexity, then we have to enhance the mechanisms to deal with complexity that we will result in more complexity. So it's and then I agree with Case. It's first, the whole discussions, they don't take into account the institutional capacities of countries, and that's something that I've been saying for quite some time. So you structure a system that is based on the institutional capacities of Norway or Sweden or the UK or the Netherlands, not in the institutional capacities of Nigeria or Ecuador. So it's really, really, really complicated. There's another topic that I would like to just plant for further discussion, which is it seems that the whole thing is triggered by a consensus that double taxation should be avoided at all costs. So whenever a DST emerges, the first thing is the first argument against it, it's going to trigger double taxation. 2 years ago, I was on a panel on a PhD thesis in Minas Gerais from Tarcísio, who is a fantastic young international tax scholar. And he was making the argument that maybe considering how depressed the income taxation is currently established, maybe double taxation is no longer, that big of a deal. So is that really a problem? Because one thing is if you are double taxing at 15, at 30, at 40%, but if you're double taxing at 3, 8, maybe that's not that big of a deal. So my suggestion, and this is I know that there's no consensus around it, but the opposite. Maybe we should think about taking a few steps back, as Kay said, and just rethink the whole permanent establishment thing. Terminate it. A world without permanent establishment. That's my point. And just a quick word on what Kay said about Pillar 3. I guess there are two Pillars 3 now. We have the Pillar 3 of Professor Alison Christians, a dear friend of mine from Canada. And her Pillar 3 developed with Tarcísio was more related to the pandemic and how to raise revenues due to the fiscal crises that we will have all over the world due to the pandemic. And now, more recently, I think a couple of months or a few months ago, Pascal Sandeman started talking about the Pillar 3 too. So just for us to be more confused about the whole thing. And I guess that his Pillar 3 is more related to what Case was saying, to find a way to have a fairer and to find a way to get the international tax regime to incorporate some redistributive keys that would lead to more revenues reaching actually poor countries. So I think that all those initiatives are valid. I don't think there's anything concrete on the table, but I think we definitely should, move in the direction of trying to make the system fairer from the perspective of the poorer countries. I don't know. I guess Case wanted to maybe make some comment. I don't know.
Hi, Case. Would you like to add something to make any additional comment on that?
Case, your mic.
No, rather speaking more myself, I think I'm interested in hearing whether there are perhaps points from the audience that they would like to raise and to have discussed by us.
Anna, can you check? And in the meantime, I will ask another question if I'm allowed to. Well, I've heard a lot that Pillar 1 would only affect technology companies. Is it a true statement, or are we changing the international tax framework for all companies? What do you think, Professor Sergio and Professor Case?
Okay, so I'll start. I think that it started, so the whole discussions, and here there's an important aspect about international taxation. It's and I always insist on this. This is not a purely technical field. There is a lot of politics involved, and international politics. So when it started, it was basically meant to deal with the purely digital businesses. And then we had all that very strong reaction from the US. And I guess that because of that strong reaction from the US, we started discussing not only how to deal with the tech, to deal with the automated digital services, but also with the consumer-facing businesses that Case explained during his first speech. And when you started talking about consumer-facing businesses, of course, you detached from the typical and purely digital and big tech companies. To a point, I remember last year, I have heard lots of concern from the natural resources industry in general. So oil companies, mining companies, because in one of the reports last year, there was a brief mention that for the time being, they were not being included in the overall concept of consumer-facing business, and that was enough for them to be really concerned. But okay, they're talking about us. So as a type of consumer-facing business that maybe could be reached under Pillar 1. I don't know. It's hard to answer your question, Edgar. I don't know if Case has a better answer than mine, but I would say that this is not only the typical tech companies anymore. It's definitely went beyond. And my point would be, it hasn't gone far enough, because it should be limitless. It should be about all business sectors with no limits whatsoever. So it's still ring fenced, but it's not ring fenced on big tech anymore. I think that would be my answer.
Just a brief comment. I fully agree with what Sergio André said. There's been this sort of move, you know, from only focusing on the digital companies. It was quite readily recognized as what they call sort of ring fencing. The digital economy doesn't work because you cannot, you know, most companies deal with digital business in some respect. And at the same time, they, being aware that the new rules would impose a lot of complexity, they wanted to keep the impact sort of limited. So it's really political, you know, where they're going to be drawing the line. It's obvious that they don't want to include the guy running a shop around the corner to be covered by this sort of rule. On the other hand, if you don't want to limit the whole thing to the sort of the 5 or the 10 major digital technical companies in the world, where are you going to draw the line? And that's part of the debate going on now within the OECD regarding what they call the scope. What is going to be the scope of Pillar 1? And that's, you know, that's again a political issue. But I fully agree with Sergio André that this certainly should not be limited to typical exclusively digitally operating businesses. I quite agree. Yes.
Fantastic. And Sergio André, he mentioned the US. We were talking a lot about the OECD. And well, the US has tried to trace its own tax policy. And now we just had elections, and we might have maybe a change of course in the US. So I would make you a very broad question. I would ask you, what should we expect from the US now after the elections and with the new government?
Well, although the new government will be met with a lot more sympathy around the world than the current one, and probably the other way around, you know, the US will be more receptive to the interests of the rest of the world than under the current administration. But in this particular respect, I don't think it's going to make a huge difference. No, the economic interests of the United States are quite obvious. And the sort of the problem is the United States is in a unique position here. It shares its position a bit with countries like China and Korea and Japan, but that's pretty much it. So, you know, if you talk about taxing the digital economy, you say you're going to tax the United States, and there's simply no way we can change that. And there was simply no way, whatever the administration is going to be in the United States, you know, they will take a fundamentally different view. That's my perspective from Europe. Maybe Sergio André, you have a different look at that.
No, in fact, to be honest, I don't think I'm qualified to actually discuss the future of international taxation in lieu of the new presidency in the United States. I think that by now we don't know much about how the Biden presidency will behave internationally. He has already nominated his Secretary of State. but I don't know much more than that. But I tend to agree with Case that, and that's something that I've been hearing commentators in general say, that some aspects of the international agenda of the U.S. In principle, they shouldn't change significantly. Maybe they would change more in terms of form, in terms of recovering some resemblance of business as usual diplomacy. That's something that we pretty much hope for Brazil in the a little bit more distant future. But in terms of economic interests, it doesn't seem that, even in the relation to China, and that's not my analysis, it's what I'm hearing from commentators, it shouldn't change significantly. Maybe just the form of doing diplomacy, but not necessarily the US goals.
Fantastic. Very, very interesting. Thank you. Thank you so much. We had a list of questions, right, Edgar? And we even have here a question from our audience, but I'm afraid we are about to reach the end of our webinar today. It was fantastic, fascinating. I loved to hear both of you, Kees van Raad and Sergio André Rocha. And I tell you from the bottom of my heart that you two are the scholars I mostly admire in the field of international taxation. You are brilliant. It was really, really great. And on behalf of BDF, FIFA Brazil, I thank you very, very much. And I thank our audience for staying with us until now. I thank my dear friend Edgar for being always a great, how could I say it? It's not a partnership. I don't know how to say it in English, but it's always a companion in many, many projects, and it was great. Thank you so much. Edgar?
Thank you, Ana. Thank you, Kees. Thank you, Sergio. It was an honor to be here with all of you. I couldn't say anything better than what Ana just said. You two are an inspiration for me. Like Ana said, Kees is also responsible for my passion for international taxation. Sergio, I have all your books. There's one actually pending, which we'll have a lunch together. I'll get your autograph. It was very good to have the opportunity to listen to both of you. Thank you very much, and have a great day.
So it's our pleasure, guys. Thank you very much.
Thank you so much. Bye-bye.
Bye-bye.
Okay, all the best.
Bye, Case.
Bye.
Nice to see you.
Sure. Bye.